challenging year for global listed infrastructure in 2023. I'm going to go back and talk a bit about the context in which the asset class performed this year by first starting with a review of performance in 2022. Now, again, 2022 is a period that was characterized by very specific macroeconomic drivers, one of which economic growth, which was slowing, inflation, which was rising quickly, and interest rates that were up over the period. This is typically a great period for infrastructure performance, both relative to its historical performance, but also relative to other asset classes. So 2022 was a year in which infrastructure outperformed both equities and fixed income by around 15%. Now, as we transition to 2023, we're talking about a slightly different macroeconomic picture, right? So we had factors such as interest rates, which continued to rise and rise substantially. We had inflation that remains above trend, but has fallen and fallen significantly, and an economic outlook that has proven to be a bit more resilient, I think, than many expected beginning of the year. So what we've seen this year is infrastructure lagging the market substantially in other asset classes. So infrastructure is down around 8% year to date through September 30th. Global fixed income down around 2%. Global equities up around 11%. I would note that a lot of that global equity performance is concentrated in tech-related sort of AI businesses, but nonetheless, infrastructure has lagged global equities as measured by nearly every sort of global equity index. Within the context of that underperformance, let's just talk about both geographic and subsector level performance. So when we think about subsectors of infrastructure, what's performed well and what's lagged, let's start with what's lagged. Simply put, the things that have lagged are the parts of our asset class that tend to have more rate sensitivity, particularly those that have heavy leverage and long duration assets. So in our world, that is utilities, both water, electric utilities, gas utilities, and telecom infrastructure, notably cell tower companies. Those have been the worst performing parts of our universe this year. The better performing parts of the universe tend to be, this year, tied to reopening. So transportation, notably passenger transportation. So airports have been the best performing part of our universe, largely again on reopening and the sort of last phase of reopening coming out of the pandemic, which has seen China really start to open their borders in a much more material way. So we've seen international travel up significantly. Then beyond that, we've seen some outperformance within the group from some of the more freight-oriented businesses. So marine ports, freight railways have modestly outperformed the broader asset class. When we think about different geographies, clearly that's been more subsector driven. What I mean by that is Europe has been the best performing geography within the infrastructure universe. Why is that? It's because of a large concentration of more transport-oriented businesses there. So airports, for example, a significant portion of the European infrastructure universe, toll roads also. If we look at the worst performing part of our universe, it's the Americas, notably the United States, where you've got a significant concentration of tower companies as well as utilities. There are a couple of themes that I'd like to address that we've spoken about in the past quite a bit, and one of which is dry powder, right? We've made the case over the years, and a case that's accelerated recently, that an increasing amount of capital that's been raised by infrastructure vehicles on the private side would ultimately find their way into the listed markets. The reality is that was a big driver for performance within the listed asset class over the past several years, as our companies began to really start to either sell assets, sell stakes in assets, or in some cases even sell themselves to private infrastructure vehicles. So we call this, again, the dry powder thesis, which was a big part of our sort of discussion around the asset class over the past 5 years. The point that I'd like to make today is that continues to be a driver, although I would say that this changed world from a cost of capital perspective that's impacting not only listed companies, but also private companies, has really slowed down the activity when we think about dry powder. So two implications for us. One, we still think there is a valuation floor that's driven by all this dry powder on the private side that ultimately has to find its way into the market. But we do think there's going to be a little bit of a lull in the action in terms of the amount of activity that we see. Second, I think, there are a handful of companies within the infrastructure universe that are relying on asset sales to improve their balance sheets. And as investors in the asset class, we have to be aware of those cases and be realistic about the ability to get those deals done and the ability to do them at attractive prices. So a lot going on still on the dry powder side, but something that is very front of mind as we think about this new regime that we're in from a cost of capital perspective. The second theme is energy transition, right? So we've talked a lot about energy transition and the implications on infrastructure. So a big part of the energy transition story relates to renewables and the movement from traditional fossil fuels to renewable energy. And that's entailed, investing by a lot of utilities in not only renewable energy generation assets, but also transmission assets to support the movement of that energy from the places where the wind blows and the sun shines to places where that energy is consumed. Now, we still believe that story is intact, but we'd like to change the narrative a little bit when we think about this transition. We want investors to remember this is not just a transition. We think about it as an energy addition. The world will continue to need more energy, and generally energy of all types, meaning we think natural gas is going to continue to play a significant role in the ultimate energy transition to renewables. So at times we've thought that the pendulum swung a little bit too far, too fast towards renewables. And we just want to make sure investors recognize that there's going to be a significant amount of growth in demand for natural gas, and that creates some really interesting opportunities for infrastructure companies. So midstream energy is one of our favorite subsectors within the infrastructure asset class. These are companies, again, that own and operate a number of energy infrastructure assets. So typically pipelines, processing facilities, storage facilities. These are businesses that, historically were spending a lot, investing a lot on new assets. I think what has changed over the past 5 to 7 years is that these companies have been a lot more disciplined. We have built out the vast majority of the energy infrastructure that we need in North America. And as we've just talked about, we do think that there are significant demands for traditional sort of energy infrastructure, even with this transition to an increasing market share for renewables. So simply put, we think these businesses are very attractive. We think that financial discipline has returned. These companies are paying out very attractive dividend yields and in fact growing their dividends at substantial rates, generating as much free cash flow as any infrastructure subsectors that we focus on. They tend to be North America focused companies. That's because most of the independent midstream companies are domiciled here. These types of assets in other parts of the world are typically owned by governments or owned by much larger energy conglomerates that tend to have more commodity price exposure, which is something that we're looking to minimize in our portfolios. These businesses perform well when production of energy is growing in their specific regions, and that is something that we've really focused on in our portfolios. So midstream energy, again, it's a changed game when we think about their capital discipline, and we expect these stocks to continue to perform well, having been among the best performing businesses within infrastructure over the past 2 years. So we expect both the U.S. and global economies to slow as we move into 2024. A number of factors leading to that slowing growth that probably leads us to a place that we're below trend on both. In fact, growth in the U.S. we expect to average around 1% in 2024, down from 2+% here in 2023. So why is that? It's the lagged impact of the tightening that we've seen over the course of the past couple of years. Some of that relating to inflation, clearly that we do expect to come down, but still stay well above trend, let's say around 3.5% as we move through 2024. which remains above consensus from our perspective, but also, the higher rates that we've seen filter their way through the market. And that clearly will have an impact on businesses, but also at some point here on consumers, on employment, et cetera. So we definitely are thinking about a growth slowdown as we move into 2024. Again, not only for the U.S., but also globally. Another factor as we think about 2024 will be the election here in the U.S. And while these things are very difficult to predict, it seems fairly clear at this point that both Trump and Biden will be serious about running in 2024, and hard to imagine that there's going to be legitimate contenders for either party as we move through that process. So our best guess right now is it comes down to Trump versus Biden. If you look back, actually, there hasn't been an incumbent that has been reelected if the U.S. has moved into a recession during the later stages of their presidency. So if we want to know, odds of Trump versus Biden, keep an eye on the economy. We'll see how that plays out, but that's been the best indicator of incumbent success in elections in recent years. I know I noted interest rates before. I think, our view is 10-year Treasury hovering around 4.5%, which is certainly above the recent trend, as we'd know. But again, between that and inflation, we continue to think that we're going to be in a tightening environment from a cost perspective for both consumers and businesses, which leads to, again, a slowdown as we move into 2024. So we think, given all that background, infrastructure is poised to perform well as we move into 2024. Again, infrastructure historically has outperformed its long-term average in periods of slowing growth and above-trend inflation, which again is a period that we think we're going to see. We're not suggesting that there's going to be a significant and deep recession, but we do think that there's going to be an economic slowdown that happens and has to happen given the tightening that we've seen. So we expect infrastructure to perform well in that context. Again, tough to say exactly relative to equities and fixed income, but certainly a rebound from its dramatic underperformance this year, in our view, is likely. When we think about valuations for listed infrastructure, they're trading significantly cheap relative to equities, given this underperformance that we've seen. Historically, infrastructure is traded at a 1 to 1.5 turn premium to global equities. Right now, infrastructure is trading at about a 0.5 turn discount to global equities. So in a period that we think will return to a focus on predictability, giving slowing economic growth and high inflation, we expect, or above trend inflation, I should say, we expect that premium to again return to infrastructure, given again its predictability of cash flows and historical performance pattern.